For decades, the dollar's dominance seemed permanent. Oil was priced in dollars. Trade was settled in dollars. Central banks held dollars. Even countries critical of American policy relied on the currency in practice. The system built after 1971 proved resilient. Financial crises came and went. Exchange rates fluctuated. But the dollar remained the anchor. Then something changed. It was not a single speech, not a dramatic declaration, not a public withdrawal. It was a shift in strategy, a series of decisions, gradual, technical, and deliberate, that signaled something new. Some nations no longer wanted to rely exclusively on the dollar. Before we continue, if you're interested in real stories about global finance, gold, and the structural shifts shaping the modern system, this channel focuses on documented developments, not speculation. Because monetary systems rarely collapse suddenly, they evolve under pressure. After the 1970s, the dollar's strength was not based on the gold. It was based on network effects. The more countries used the dollar, the more useful it became. Global trade contracts were written in dollars. Commodities were priced in dollars. Debt was issued in dollars. Even countries seeking independence from US influence often found themselves holding dollar reserves for practical reasons. Alternatives existed: the euro, the yen, later the yuan, but none matched the depth of US financial markets. Liquidity mattered. US Treasury bonds provided scale and safety. Dollar clearing networks were established and reliable. Financial institutions were integrated. The system was not maintained by force. It was maintained by convenience and scale. But convenience can erode, and scale can be challenged slowly. The first visible cracks did not appear in oil markets. They appeared in finance. The global financial crisis of 2008 began in the United States, but spread rapidly across the world. Dollar liquidity tightened. Credit markets froze. International trade slowed. In response, the Federal Reserve introduced extraordinary measures: emergency lending facilities, quantitative easing, swap lines with foreign central banks. These actions stabilized the system and in fact reinforced the dollar's central role. But they also revealed something important. Global financial stability depended heavily on decisions made in Washington. For many countries, this dependence became a strategic concern. If US monetary policy could transmit volatility globally, then reliance on the dollar carried risk. In the years that followed, several central banks began quietly adjusting their reserve strategies. They did not abandon the dollar. They diversified. Gold purchases by central banks increased after 2008. Bilateral currency swap agreements expanded. Regional financial mechanisms developed. The system did not fracture, but hedging began. The shift became more visible after 2022. Sanctions imposed on Russia following the invasion of Ukraine included freezing a substantial portion of its foreign exchange reserves held abroad. For many governments, this was a defining moment. Reserves held in dollars and euros, once assumed untouchable, could be restricted under geopolitical pressure. This did not eliminate the dollar's dominance, but it altered the perception of neutrality. Central banks in several countries increased gold purchases at record levels. Discussions of trade settlement in local currencies gained traction. BRICS nations expanded dialogue about alternative payment systems. Some energy transactions began to be denominated in currencies other than the dollar. These developments were incremental, not revolutionary. The dollar remained the primary reserve currency. But the conversation had changed. The challenge was no longer theoretical. It became structural risk management, not rebellion. Rebalancing. BRICS began as an economic acronym. Brazil, Russia, India, China, South Africa. Initially, it represented emerging market coordination rather than a monetary alliance. But over time, its function evolved. Meetings expanded in scope. Discussions moved beyond development financing into trade settlement and financial architecture. By the early 2020s, the group signaled interest in expanding membership. Additional countries expressed interest in joining. Energy producers, regional powers, economies with significant commodity leverage. The relevance of this expansion was not symbolic. It was structural. If a coalition representing a substantial share of global population and energy production explored settlement outside the dollar system, even partially, the long-term implications were significant. The objective was not immediate replacement. It was optionality. Diversified payment channels, reduced exposure to sanctions risk, increased leverage in trade negotiations. The dollar's dominance did not vanish, but a coordinated platform for alternatives gained visibility, and visibility changed expectations. While public debate focused on currencies, central banks acted in quieter ways. Gold purchases accelerated sharply in the years following 2008, and again after 2022. For central banks, gold offered qualities different from reserve currencies. It carried no counterparty risk. It was not issued by another government. It could not be frozen by foreign policy decisions. Gold did not generate yield, but it generated autonomy. In an environment where geopolitical tensions influenced financial flows, gold functioned as neutral reserve diversification. Data from central bank reports showed record net gold purchases in recent years. These purchases did not signal imminent abandonment of the dollar. They signaled insurance. Diversification does not imply collapse. It implies coercion. The same metal that once anchored the global system began reappearing as a hedge within it. The challenge to dollar dominance was not loud. It was strategic. For emerging economies, diversification offers strategic flexibility. If trade can be settled in multiple currencies, dependence on a single monetary channel decreases. Countries facing geopolitical pressure may gain negotiating space. Energy exporters can expand their client base without exclusive pricing constraints. Regional alliances can strengthen financial cooperation. Diversification also reduces exposure to exchange rate volatility linked to US monetary policy. When the Federal Reserve raises rates, global capital often flows toward dollar assets. Emerging markets can experience currency pressure and higher borrowing costs. A more diversified settlement system may soften that transmission. For commodity producers, pricing flexibility can align trade flows more closely with political partnerships. For central banks, holding a mix of currencies and gold reduces concentration risk. The benefit is not dominance. It is resilience. A diversified system does not eliminate the dollar. It distributes dependency. For the United States, the challenge is subtle. Dollar dominance has provided financial advantages for decades. Lower borrowing costs, deep capital markets, geopolitical influence through financial channels. If alternative settlement systems expand significantly, the structural demand for dollars could gradually decline. Reduced demand does not mean immediate crisis, but it can shift long-term dynamics. Less global reliance on dollar reserves could reduce the automatic recycling of foreign surpluses into US Treasury markets. Sanctions power could become less absolute if alternative payment systems mature. Leverage derived from central clearing position could weaken incrementally. The key word is incremental. No single agreement dismantles the system built over half a century. But cumulative adjustments alter balance. The dollar's dominance has endured through scale and trust. A challenge does not erase those foundations. It tests them. Despite increasing discussion, de-dollarization faces structural constraints. Global trade networks are deeply integrated into dollar-based infrastructure, clearing systems, settlement mechanisms, derivatives markets, sovereign debt issuance. These systems did not emerge overnight. They evolved over decades and are supported by legal frameworks, liquidity depth, and institutional familiarity. Replacing such infrastructure requires coordination on a massive scale. Even countries seeking diversification must consider trade-offs. Alternative currencies may lack sufficient liquidity. Capital controls may restrict free convertibility. Bond markets may not match the depth of U.S. Treasuries. Reserve managers prioritize safety, liquidity, and return, in that order. While diversification is rational, concentration persists where markets are deepest. In addition, the dollar benefits from network inertia. When most participants use one currency, switching becomes costly. Trade contracts, debt obligations, and commodity pricing are embedded in established systems. Structural change, if it occurs, is gradual. Displacement is not only economic, it is institutional. Even amid rising diversification, the dollar remains dominant. It accounts for a large share of global reserves. It remains central to cross-border lending. It anchors commodity markets. The United States continues to offer deep, transparent capital markets. U.S. Treasury securities remain among the most liquid financial instruments globally. Legal institutions and financial reporting standards reinforce investor confidence. Challenges exist. Debt levels are debated. Political polarization creates uncertainty. Geopolitical tensions persist. Yet scale and trust have not disappeared. They are tested. The dollar's dominance was not built solely on oil or sanctions. It rests on economic size, financial openness, and accumulated network effects. A challenge does not equal collapse. It signals competition, and competition in global finance unfolds over decades. For more than half a century, the dollar has anchored the global system. It replaced gold. It absorbed oil. It integrated trade, debt, and reserve management into a single network. Today, that network is under scrutiny. Central banks diversify. Regional alliances experiment. Gold reappears in reserve strategies. Alternative payment systems develop. None of these shifts, individually, dismantle the dollar's dominance, but together, they introduce a new dynamic: optionality. The system built after 1971 was defined by necessity. Oil required dollars. Trade required liquidity. Liquidity required scale. The emerging environment is defined by risk management. Countries seek resilience against sanctions exposure. They seek insulation from external monetary shocks. They seek flexibility. The challenge to the dollar is not ideological. It is structural hedging. History shows that anchors shift when underlying conditions change. Gold anchored the system until arithmetic made it unsustainable. Oil anchored the dollar until structural demand became embedded. Scale anchored the system through network effects. The current moment is not collapse. It is recalibration. The dollar remains central, but centrality is no longer assumed. It is evaluated. And that evaluation raises the final question: is the world moving away from the dollar, or simply building insurance around it?